Open your eyes for just one moment before this video begins because what you are about to hear is not a prediction. It is not a theory. It is not the raving of a man who keeps gold bars under his floorboards and distrusts the postal service. What you are about to hear is a chronicle of deliberate institutional silence. A silence that began in 1995 and has never been broken. A silence that 5 United States government agencies entered simultaneously without explanation, without press release, without so much as a footnote in the Federal Register. Silver was trading above $80 an ounce just 3 weeks ago. It is sitting at $67 today. Gold touched $5,589 per ounce in January, an all-time record, and it has since pulled back to $4,430. In the span of a single announcement, a single name spoken from the White House, the precious metals market experienced a repricing event that Bloomberg called a healthy correction, that CNBC called profit-taking, and that I am going to tell you with evidence you can verify yourself was neither. My name is John. This is the OG John, and what happened in this market was not an accident. It was a gift, and most people just handed it back. Kevin Warsh is not a name that travels well through popular culture. He does not appear on Sunday morning television with the regularity of a central banker who craves the camera. He is a former Federal Reserve governor, a man who sat inside that institution during the catastrophic unraveling of 2008, who watched Lehman Brothers dissolve into history, who watched the repo market seize like an engine without oil, and who then spent the years after his service at Stanford's Hoover Institution systematically dismantling the intellectual architecture of the policies he had helped construct. He argued methodically and publicly that zero interest rates were not salvation. They were a slow narcotic. He argued that quantitative easing, the practice of the Federal Reserve conjuring money to purchase government debt, was a form of institutional dishonesty that would eventually present a bill the country could not pay. He argued that the dollar needed to be defended, not diluted. When President Trump named Warsh as his pick for the next chairman of the Federal Reserve, the algorithmic trading systems that now constitute the majority of daily market volume did what they are programmed to do. They executed the textbook trade. Hawkish Fed chair means higher interest rates. Higher interest rates mean a stronger dollar. A stronger dollar means commodities priced in dollars become more expensive for foreign buyers. And non-yielding assets like gold and silver, which pay no dividend and throw off no coupon, become less attractive relative to bonds and cash. Within hours, gold dropped over $100. Silver cratered nearly $5 in a single session, falling from the mid-70s back toward 67. The financial press opened its word processors and typed the same sentence in 17 different ways. Nothing to see here. Move along. The algorithms were correct about the mechanics of the trade. They were profoundly wrong about the context in which that trade was being executed. And the context is everything. The context is the story that nobody is covering. And it begins with a gap in the data so conspicuous, so structurally persistent, that once you see it, you cannot unsee it. The Silver Institute publishes what is, by universal consensus among analysts, the most authoritative annual survey of silver supply and demand on the planet. Every major bank references it. Every commodity research desk begins its silver analysis with its numbers. They are meticulous about solar panel consumption, about jewelry, about silverware, about brazing alloys, about photography. A category that has been declining for decades and still receives its own dedicated line item. You know what does not appear anywhere in the Silver Institute's data? Defense, aerospace, military consumption. It does not exist as a category. It has never existed as a category. There is no line in the most authoritative supply and demand model in the industry that accounts for what the United States military or any other military on Earth consumes in silver each year. And this is not a rounding error. Rounding errors do not disappear across multiple decades of annual publication. Rounding errors do not coincide with the simultaneous decision of 5 United States government agencies to stop reporting silver usage data in 1995 and 1996. And yet that is precisely what happened. The Department of Defense and 4 associated agencies went dark on silver consumption reporting at exactly the moment when precision-guided munitions were becoming the foundational architecture of American military power. At exactly the moment when the Tomahawk cruise missile program was expanding. At exactly the moment when military electronics were becoming exponentially more silver-intensive. 5 agencies, 1 year, no explanation, never resumed. I have been doing this long enough to know the difference between an administrative oversight and a decision. That was a decision. Now, I want to be precise with you here because precision is the only currency that matters on this channel, and imprecision is the weapon that critics use to dismiss arguments that inconvenience them. There is a number that has circulated through the precious metals analysis community for years, repeated across blogs and forums and YouTube channels with the confidence of scripture. The claim that a single Tomahawk cruise missile contains 480 to 500 ounces of silver. It is repeated constantly. It is also wrong. CPM Group, one of the most rigorous and frankly most skeptical precious metals research firms in existence, has looked at this directly. Their published analysis puts the actual silver content of a Tomahawk closer to 10 to 15 ounces per unit, concentrated primarily in solder and the ignition battery. Smaller precision munitions used in active conflict zones carry less than 1 ounce each. Acknowledging this matters because the argument for hidden military silver demand does not need exaggeration. The real numbers, the ones that can be defended from the public record, are more than sufficient to reframe everything the mainstream financial press is telling you about this market. Here is what is publicly confirmed and not seriously disputed. Silver-zinc batteries power the guidance, telemetry, and actuation systems in the Tomahawk, the Patriot, the Thea-AD, the Hellfire, and the Standard missile family. Eagle Pitcher, the dominant United States military battery supplier, confirms this directly in their corporate specifications, which are publicly available. Silver-zinc chemistry is not unique to American military platforms. Combat torpedo specifications from Germany, France, Italy, India, and Russia all specify silver-zinc cells. This is a global military dependency, not an American quirk, and the critical characteristic of every one of these applications is that they are single-use. Fire and discard. When a missile launches, the silver inside it is gone permanently. There is no recovery. There is no recycling. Each unit fired represents an irreversible destruction of available supply. Beyond munitions, military-grade avionics operate under what is known as Mil-Spec QQS-365, the United States military's reliability standard for electronic connections. Silver-plated connectors, wiring harnesses, and circuit boards appear throughout combat aircraft, naval vessels, and ground-based defense electronics because the military cannot afford what civilian engineers can tolerate. In a consumer product, failure means your phone reboots. In a combat aircraft, failure means loss of the aircraft, loss of the crew, and loss of the mission. Copper is cheaper. Aluminum is lighter. Neither one meets the conductivity, corrosion resistance, and thermal reliability requirements that silver provides in environments where the margin for error is measured in milliseconds and the consequences of error are measured in human lives. The military does not substitute silver because it cannot. Applying CPM Group's per unit framework to available defense electronics production data, the defensible estimate for global defense and aerospace silver demand sits somewhere between 15 and 40 million ounces annually. The range is wide because the data is structurally thin, which is itself a signal worth noting. But even at the conservative end, 15 million ounces is a demand layer of genuine consequence, invisibly embedded in broader industrial categories, unattributed, uncounted, and critically not included in the 67 million ounce annual structural deficit that the Silver Institute is already warning about in its official projections. The real deficit is larger than anyone is reporting, and the people who set the price on your screen do not appear to know it. Or perhaps they know it very well. Before I show you what is about to accelerate this demand into territory that no pre-2026 model can account for, I need you to do something right now. Hit that subscribe button and turn on the bell notification. Not because the channel needs numbers, not because I am fishing for metrics, but because when the next data point lands, when the next defense appropriations bill passes, when the next strategic mineral procurement announcement comes through, you need to see this analysis in real time. You need it before CNBC decides 3 days later that the story is worth covering, by which time the market will have already moved. Subscribe right now, turn on the bell, then come back because what I am about to show you is the structural acceleration that makes everything I just described not merely significant, but urgent. Global defense spending crossed $2.63 trillion in 2025. That is a record. NATO members who spent years negotiating the political cover to reach 2% of GDP are now publicly pledging to ramp toward 5% by 2035. China's defense budget for 2026 is approximately $275 billion, representing a 7% year-over-year increase that has not slowed once in a decade. Russia is spending at wartime production levels. India is expanding its procurement pipeline with a velocity that has no recent precedent. South Korea, Saudi Arabia, and the Gulf states are all in active modernization cycles. Every major military power on Earth is simultaneously increasing expenditure, and every dollar of that expenditure flows downstream into the electronics, guidance systems, communications equipment, and munitions that consume silver. This is not one country making a defense procurement decision. This is a generational global rearmament cycle, and it is happening right now. While silver trades at $68 an ounce and the financial press is writing about Fed chair appointments, the second accelerant is the drone. The military drone market is undergoing a proliferation that the pre-2022 analytical framework simply cannot model. Ukraine demonstrated to every defense ministry on Earth that modern conflict consumes unmanned aerial vehicles at a rate no peacetime planner anticipated. Loitering munitions, the military's term for what are essentially single-use guided drones, are being produced at scale across dozens of nations. Each one carries silver in its electronics and guidance circuitry. Even at modest per-unit silver loadings, a fraction of an ounce, the multiplication effect of producing hundreds of thousands of expendable platforms annually compounds into an aggregate demand figure that would make the Silver Institute's categorization problem significantly worse than it already is. The third accelerant is restocking. NATO inventories across multiple munitions categories were drawn down materially during the conflicts of the past 4 years. Every major alliance member is now in active procurement mode, even applying CPM Group's conservative 10 to 15 ounce per unit estimate for advanced missile systems. Restocking at anything approaching wartime replacement rates across hundreds of thousands of units in active inventories generates silver demand that is consequential in the context of a market already running a structural deficit. The fourth accelerant has no historical precedent in the silver data because it did not exist at meaningful scale until recently. Hypersonic weapons programs in Russia and China are forcing an acceleration of equivalent NATO development that is being funded at emergency pace. Silver appears in the thermal management and sensor electronics of these platforms. This is an entirely new demand category classified at the production level, recent enough that the Silver Institute's historical methodology cannot capture it, and growing fast enough that the gap between what the official data shows and what the physical market is actually consuming will widen further with every passing quarter. The fifth accelerant is the one that should prompt a fundamental reassessment of the narrative the financial press is selling you about the sell-off you just witnessed. Project Vault. The Trump administration's $12 billion strategic minerals stockpile initiative, backed by $10 billion in export-import bank financing, explicitly lists silver among the 60 critical minerals the United States government is now formally stockpiling. A government procurement channel for silver now exists that did not exist 1 year ago. Let that sit with you for a moment because it is the most remarkable juxtaposition in the current market. The United States government is actively building a strategic stockpile of silver while the retail investor is selling their position because a Fed chair got named. One of those two actors has access to classified demand data. One of them is making decisions based on information that does not appear in the Silver Institute's annual survey. I will leave it to your judgment which one is better informed. Now let us return to Kevin Wersch and follow the logic of the textbook trade to its actual conclusion, rather than the comfortable conclusion that CNBC is prepared to offer. The United States is currently running a federal deficit in excess of $2 trillion annually. The national debt sits above $36 trillion. The interest expense on that debt, as rates have climbed from their historic lows, has already surpassed defense spending as the largest single line item in the federal budget. If Wersch governs, as his public record suggests he would, and interest rates rise further, the arithmetic becomes merciless. Higher rates mean higher servicing costs on $36 trillion of existing debt. The Treasury must issue more bonds to cover the widening deficit. Foreign central banks, who have been quietly diversifying away from dollar-denominated reserves since 2022, are less enthusiastic buyers of those bonds than they once were. When Treasury auctions show weakness, yields spike. When yields spike, mortgage rates follow. 8 or 9% mortgage rates do not coexist peacefully with a housing market priced for a 4% world. Corporate borrowing costs explode. The companies that have been refinancing survival loans at suppressed rates cannot survive the reset. Credit markets freeze. Unemployment rises. Consumer spending contracts. That is deflationary. And in a genuine deflationary credit crisis, gold and silver are not merely desirable. They're the last asset standing because they carry no counterparty risk. They are not a promise. They are not someone else's liability. They cannot be defaulted upon. If Wirsch, confronted with this scenario, chooses the other available path and restarts quantitative easing to prevent the collapse, the dollar loses the credibility it purchased at the cost of a decade of suppressed yields. Inflation expectations become unanchored. Foreign central banks accelerate their exit from dollar-denominated reserves. Gold, already at $4,400 an ounce, has nowhere to go but substantially higher. Silver, which moves with gold but with greater volatility and the additional tailwind of an industrial demand story that gold does not possess, follows with amplified force. Both paths from the wash appointment lead to the same destination for precious metals. The sell-off was not the market pricing in a bearish future for silver. The sell-off was the market executing a reflex, a Pavlovian response to a stimulus that was correctly identified, but catastrophically misinterpreted in the context of a supply and demand situation that the textbook does not account for. Here is the arithmetic plainly stated. The Silver Institute reports total global silver demand at approximately 1.22 billion ounces annually. Mine production is approximately 820 million ounces. Recycling adds another 180 million. Total supply is roughly 1 billion ounces. That is a 200 million ounce annual deficit being filled by drawing down above-ground stockpiles. Those stockpiles are finite. They are shrinking. The mines cannot double their output in response to a price signal. The lead time from discovery to production for a new silver mine is 7 to 10 years at minimum. There is no supply response that closes this gap in any time frame that matters to anyone managing a portfolio in 2026. Add 15 to 40 million ounces of annual military demand that appears nowhere in the official data, and the real structural deficit is between 215 and 240 million ounces per year. The gold-to-silver ratio today sits at approximately 65 to 1. Already down from the absurdity of the 88 to 1 levels seen in prior years, but still well above the long-run historical average of 60 to 1, and dramatically above the crisis ratios of 15 to 20 to 1 that appeared during genuine monetary and industrial supply dislocations. If silver merely returns to the 60 to 1 historical average with gold at current prices, the math requires silver to move meaningfully higher from where it trades today. If the market enters a crisis ratio compression, the numbers become extraordinary. These are not fantasy projections. They are historical ratios that have occurred repeatedly across centuries of precious metals trading. The only variable that has changed is the magnitude of the industrial demand underpinning silver's case, which in 2026, between solar manufacturing consuming over 160 million ounces annually, electric vehicles embedding silver in every sensor and electrical contact, fifth-generation wireless infrastructure requiring silver and antenna arrays and connectors, and military consumption at levels that no official survey is capturing, is larger than at any previous point in the metal's history as an industrial commodity. And now I want you to consider a historical parallel, because understanding where we are requires understanding where we have been. In 1979 and 1980, Nelson and William Hunt accumulated a physical silver position of such scale that the price moved from $6 per ounce to nearly $50 in less than a year. The exchange ultimately intervened, implementing liquidation on orders that forced the brothers to sell and collapse the price. The mainstream retrospective on the Hunt episode treats it as a cautionary tale about greed and speculation. What the mainstream retrospective almost never discusses is what happened to the industrial users of silver during those 14 months. Kodak, then the largest industrial consumer of silver on Earth by virtue of its photographic film operations, was in genuine supply crisis. Boeing could not secure the silver it needed for avionics manufacturing. Defense contractors were scrambling. The price explosion was not purely speculative. It was the market's signal. Chaotic and violent and ultimately suppressed by institutional intervention, that the physical supply of silver was inadequate for the combined weight of investment demand, monetary demand, industrial demand, and military demand pressing simultaneously against a market that the official data suggested was imbalance. The exchange intervened to protect the short sellers, not because the supply problem was solved. The supply problem was never solved. It was deferred. We are not in 1979. We are in a moment when the demand side of the silver equation is incomparably larger than it was during the Hunt episode. When the industrial drivers are not photographic film, but the electrification of the global economy. When the military drivers are not a Cold War arms race conducted with analog electronics, but a 21st century rearmament cycle built on precision guidance, autonomous systems, and hypersonic platforms. And when the institutional infrastructure for paper price suppression through futures markets is being examined with a skepticism that it has not faced in decades, go to any coin dealer this week, call them, Ask what they are charging for Silver Eagles above spot. You will hear premiums of $5 to $8 per ounce. Ask what they are charging for Gold Eagles above spot. You will hear premiums of $80 to $100 per ounce and frequently higher. Those premiums are the physical market's honest assessment of actual metal availability. The COMEX can set whatever paper price the algorithmic systems agree to through the futures market, and only a fraction of those contracts will ever result in physical delivery. The number on your screen is a price discovery mechanism for paper promises. The number your coin dealer quotes you is the price discovery mechanism for actual metal in the actual world. The gap between those two numbers is the gap between what the market says silver is worth and what the people who actually want to hold it in their hands are willing to pay. That gap is meaningful. That gap is a signal. Here at the OG John, the function of this channel is not to sell you silver. There is no metal for sale here. There is no referral arrangement with a dealer. There is no financial incentive attached to what you are hearing. This channel exists because the information asymmetry between what institutional actors know and what retail investors are told is not a minor inconvenience. It is the mechanism by which money transfers from people who rely on CNBC to people who do not. The Kevin Wersch sell-off was a transfer event. The people who panicked when gold dropped and silver cratered transferred their positions to buyers who understood that a Fed chair appointment, however consequential for the direction of interest rate policy, does not alter the physical supply situation of a metal that is being consumed faster than it is being produced, in applications that range from the solar panels going on rooftops in Germany and India to the munitions going into the restocking pipelines of every NATO member on Earth, and that the government of the United States has now formally designated as a strategic resource worth $12 billion of procurement capital. The disconnect between the paper price and the structural reality is, in the judgment of this channel, as wide as it has been at any point in recent memory. Sentiment-driven sell-offs and structurally broken markets are not disasters. They are for those who understand the structure. The moments that history later identifies as the gift that most people refuse to accept. So here is what I need from you right now, and I mean this in the most direct possible terms. Tell me in the comments where you are watching from. Tell me your country, your city, if you are comfortable. Tell me if you work in defense manufacturing. Tell me if you work in aerospace. Tell me if you have firsthand knowledge of silver usage in military applications that does not appear in any public data set. I am not asking for classified information. I am asking for the kind of ground-level confirmation that the official sources, having gone dark in 1995 and never resumed reporting, cannot provide. You are the research network. The comment section of this video is a collective intelligence instrument, and I intend to use it as one. The algorithm decides how many people see this analysis in the first hour based on your engagement. Comment, like, share this with one person who owns precious metals or is thinking about buying. They need this data before they make a decision based on a financial press that has never, not once, opened a USGS mineral commodity summary and asked why 5 government agencies stopped reporting the same data in the same year without explanation. The sell-off you witnessed was not a crash, it was a shakeout. And the people who handed back the most strategically consequential metal on Earth because a talking head told them to be frightened are going to look at this moment in the not particularly distant future and understand exactly what they gave away. Do not be frightened, be informed, be early, be positioned.